Imagine maxing out your credit cards. Now imagine you turn around and lend yourself the money to pay them off. Sounds crazy, right? It's the kind of circular logic that would get any of us bankrupt in months. But what if I told you that this is exactly how the US government finances itself? They borrow money by issuing bonds, then buy those bonds through their own central bank. On paper, it looks like the US is paying itself with money it doesn't have. In reality, it's the biggest financial trick in the world, the invisible foundation of the global economy. The question isn't whether the trick is clever. It's how long it can last before the illusion shatters. The cost of this trick, it's paid by you, and I'm going to show you how. Part 1. The core deception, how the borrow from yourself trick works. To understand this game, we need to start with the basics. A government bond is, at its core, an IOU. When the US Treasury issues a bond, it is saying to the buyer, "Lend me money now, and I'll repay you later with interest." Bonds are supposed to be the safest investment in the world, backed by the full faith and credit of the United States. And for over 2 centuries, that faith has been strong enough to keep the US running deficits year after year, spending more than it takes in taxes, confident that there will always be buyers for its debt. This system goes back to the early days of the Republic. After the Revolutionary War, the young US government was drowning in unpaid debts to soldiers, suppliers, and foreign backers like France. Alexander Hamilton, the first Treasury Secretary, saw that honoring those debts with new bonds would build credibility. It worked. By proving it would pay, the US convinced investors to keep lending. But from that moment on, the nation was locked into a cycle, borrowing, rolling over old debts, issuing new ones. Bonds became the lifeblood of American finance. The real transformation came with the creation of the Federal Reserve in 1913. Before then, the US banking system was chaotic, prone to panics and collapses. The Fed was designed to stabilize the system by acting as a lender of last resort. But it also became the government's partner in sustaining debt. When World War II broke out, the Treasury needed mountains of money to fund the war effort. The Federal Reserve stepped in, agreeing to buy government bonds whenever necessary to keep borrowing costs low. In effect, the US had found a way to guarantee demand for its debt. The Fed could simply create money and use it to buy treasuries. This started the machine, but it was nothing compared to what was to come. Part 2. The global stage, how the dollar became a weapon. Then came 1971, the year the trick went global. Until then, the US dollar was tied to gold. Foreign governments could, in theory, demand gold in exchange for their dollars. But as American debt ballooned from Vietnam War spending and domestic programs, confidence in the dollar wavered. President Richard Nixon ended the gold standard, severing the link between the dollar and anything tangible. From then on, the dollar's value rested solely on trust and on the willingness of investors to keep buying US bonds. The system became pure paper, pure faith. So how does it work today? The Treasury issues bonds to cover government deficits. Investors buy them, foreign governments, pension funds, banks. But when demand falters, the Federal Reserve itself steps in. It creates new money digitally, typing numbers into existence, and uses that money to buy treasuries. This is what happened on a massive scale after the 2008 financial crisis and again during the pandemic. The Fed bought trillions of dollars of bonds, effectively financing the government's spending with money created out of thin air. The US was, in practice, buying its own debt. To ordinary people, this sounds absurd, almost conspiratorial. How can a country borrow from itself? How can it create money from nothing and call it wealth? Yet this is the core of the modern financial system. It's how wars are fought without raising taxes. It's how stimulus checks appear in your mailbox. It's how Wall Street bailouts are paid for when the system melts down. And while it looks like magic, there's a cost paid not by Washington or Wall Street, but by you, through the hidden tax of inflation. Part 3. The hidden tax, inflation, and the silent transfer of wealth. Let's strip away the jargon and see how the trick really works today. The US Treasury needs money because the government spends more than it collects in taxes, so it issues bonds, promises to repay in the future with interest. These bonds are sold at auction, snapped up by a mix of buyers, foreign governments like China and Japan, investment funds, banks, pension funds, and insurance companies. They buy treasuries because they're seen as the safest asset in the world. But the most powerful buyer isn't any of these. It's the Federal Reserve, the US central bank. Here's where the trick happens. The Fed doesn't have to raise taxes or dig into savings to buy treasuries. It simply creates money digitally. When the Fed decides to buy bonds, it adds numbers to its balance sheet and transfers those funds to the sellers. Just like that, new money enters the system. The government has borrowed, the Fed has bought, and the cycle continues. To the outside world, it looks like America has financed itself with invisible money, and in a way, it has. This is not a theoretical process. It's been used aggressively in every crisis of the last century. During the 2008 financial crash, the Fed launched quantitative easing, buying up trillions of dollars in treasuries and mortgage securities to stabilize the system. During the pandemic, it did the same on an even bigger scale, financing emergency spending and stimulus checks. Without this bond trick, the US government would have had to raise taxes massively or slash spending. Neither was politically possible, so instead it leaned on its own central bank to print the difference. The winners of this game are obvious. Politicians get to spend without directly confronting taxpayers. Banks and investors get liquidity and asset prices propped up by Fed purchases. Foreign governments, for now, still hold treasuries as the safest bet. The losers? Ordinary citizens. Because while the system looks smooth, the hidden cost is inflation. Every time new money is created to buy bonds, the value of existing money is diluted. You pay more at the store, your savings erode, and your wages lag behind. Inflation is the quiet tax that makes the bond trick possible. Part 4. The ticking clock, dependency and the waning of an empire. There's another consequence, dependency. The US has run deficits for decades, and debt has piled up to over $30 trillion. That number is not shrinking. Foreign governments once eagerly financed America's borrowing, but that appetite is waning. China and Japan, the two largest foreign holders of treasuries, have been reducing their stakes. As global trust shifts, the US increasingly relies on its own central bank to keep the wheel turning. That means more money creation, more inflation pressure, and more fragility if confidence cracks. This isn't unique to America. Empires have always used debt to project power. Britain financed its navy and colonies on a mountain of bonds until after World War II, when the pound lost its global dominance and the debt burden became unbearable. France in the 1700s turned to bond issuance and money tricks to finance wars, only to collapse into revolution when the system imploded. History tells us the pattern clearly. Debt can fuel empires, but eventually the trick runs out of trust. The US still gets away with it because of one extraordinary advantage. The dollar is the world's reserve currency. Oil is priced in dollars. Global trade is settled in dollars. Central banks around the world hold US treasuries as their safest reserves. This creates a unique loop. The US issues debt, the world buys it, and the dollar remains dominant. It's a financial empire built not on gold or land, but on trust in American IOUs. But cracks are showing. Countries in the BRICS bloc are exploring alternatives. Central banks are stockpiling gold, and whispers of de-dollarization are growing louder. If the world decides US debt is no longer the safest bet, the trick could unravel fast. So why should you care about this bond trick? Because it isn't some abstract accounting game. It shapes your daily life, your savings account, your grocery bill, your mortgage. Every time the government leans on the Federal Reserve to buy its debt, more money is created. Every time more money is created, your dollars lose a little of their value. That's why inflation feels like theft. It is theft, a quiet transfer of wealth from ordinary people holding cash and wages to elites holding assets that rise in price. The illusion works as long as people trust that US treasuries are safe, that the dollar will hold, that inflation won't spiral out of control. But history tells us illusions break. In Weimar Germany in the 1920s, government printing to cover debts turned into hyperinflation that wiped out savings overnight. In the 1970s, after Nixon ended the gold standard, the dollar collapsed in value, and Americans lined up for gas under double-digit inflation. Even now, after years of quantitative easing and pandemic stimulus, we're seeing echoes of those crises in rising prices, housing bubbles, and fragile markets. The real danger isn't just inflation, it's fragility. If foreign buyers lose faith in treasuries, the US will be forced to finance more of its debt at home. That means heavier reliance on the Federal Reserve, more money creation, and an even steeper inflation tax on Americans. And if confidence in the dollar cracks, the entire global financial system, built on those IOUs, could shake. The US would face the fate of every empire that borrowed too heavily, the bill coming due. This is why understanding the bond trick matters. It shows how money and power intertwine, how the government avoids hard choices by borrowing from itself, and how the costs always land on the public. It reveals why debt keeps climbing no matter who is in office. Because the bond trick isn't partisan, it's structural. It's the invisible machine that keeps the empire running until it doesn't. So what's the lesson? That financial education means seeing through the illusion, recognizing that government debt isn't free, that inflation is the hidden tax, that trust is the only thing standing between stability and collapse. It means asking hard questions about your own finances. If the system wobbles, do you have assets that hold value? If inflation rises, do your savings survive? If trust in treasuries fades, do you understand the risks in your pension, your mortgage, your paycheck? Because when this trick falters, it won't be Washington or Wall Street paying the price. It will be you. History doesn't repeat, but it rhymes. Britain once financed its empire on bonds until trust collapsed. France drowned itself in obligations before revolutions swept it away. And now America plays the same game, borrowing endlessly, buying its own debt, selling the illusion that it can last forever. But illusions end. The only question is when. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.